What I'd like to talk about today is how you think about retirement, whether you're 20, 30, 40, 50, or 60, in a rising interest rate environment. How we think about allocation in a rising interest rate environment when you're in your 20s or 30s, basically it's 100% equities. You have the luxury of time, you can ride the ups and downs, so that is pretty easy. It's when you get into your 40s, 50s, and 60s that you need to make some changes to your allocation. So let's talk about the allocation. It's the buckets that you fill. When you're in your 20s and your 30s, 100% equities. When you turn 40, now we're talking about 90% equities, 10% fixed income. When you're 50, it might be 80-20. When you're 60, it might be 70-30. So let's talk about interest rates. As we probably know, interest rates peaked in 1980 after the inflationary 70s. They were at over 15%. For the last 40 years, we've seen a drop in interest rates until we bottomed out at 0.52 on the 10-year Treasury back in COVID. So that was a 40-year bull market in bonds. Today, rates have gone up. And if we are in a rising rate environment, there are several things that we need to think about in those 90-10 or 80-20 buckets, depending on how old you are. So some things to think about of how we fill those buckets. Let's say you're 40 years old and you're a 90-10. The things when a rising rate environment that we need to do, first of all, shorten duration of your bonds. It's less sensitive to interest rate movements up. And as you know, when rates go up, bond prices come down. The second thing you need to think about is perhaps taking advantage of high yield savings accounts or money market funds or CDs that will help you in the long run. And as they mature, you can go and repurchase those CDs. The last thing you need to think about in a rising interest rate environment is your allocation between growth and value equities. It's a mathematical formula. Growth equities have more emphasis put on future cash flows. When rates go up, the value today of those future cash flows is less. In a value-oriented security, the valuation, by almost definition, is less for a future cash flow. So you may want to consider increasing the value component of your equities and decreasing the growth component of your equities. So that is how you think about investing, whether you're 20 or you're 60. We're hoping to do more detailed, deep dive videos in the future, so please check back. I'm Charlie from Moran Wealth Management. We look forward to seeing you again soon.